Two investors, same $50,000 to start, same 30-year time horizon, same average annual return on paper. One of them ends with roughly $400,000 less than the other. And the reason has nothing to do with stock selection, nothing to do with timing the market, nothing to do with risk tolerance or skill. It comes down to a structural inefficiency, so quiet, so embedded in how dividends actually work, that most investors never question it. By the end of this video, you will understand exactly what that inefficiency is, and why it compounds silently against you every single year for 3 decades. Meet Daniel. He's a disciplined investor. Every month he receives dividend payments from a well-diversified income ETF, something like schd. He reinvests them. He feels the income. He can see the cash arriving. That feels like progress. Meet Ethan. He holds a growth-focused portfolio, something closer to QQQ. No dividends, no cash tax payments. The money just stays inside the companies, reinvesting at the corporate level. His brokerage account looks quieter. Same $50,000, same 30 years, same broad market exposure. Here is the question this video answers. If their nominal return is the same, how can one end up $400,000 ahead? By the end, one of them is unknowingly paying a hidden compounding tax every single year, not as a penalty, not as a fee, but as a structural consequence of how dividend investing actually works. Let's build this from the ground up. Daniel holds SD, the Schwab US Dividend Equity ETF. Historically, it yields somewhere around 3.5% annually in dividends. On a $50,000 portfolio, that's $1,750 per year being paid out to him. Now, those dividends are classified as qualified dividends by the IRS. If Daniel earns a median household income, his federal tax rate on those dividends is 15%. $1,750 in dividends multiplied by 15% tax equals $262.50 gone every year. That's not a large number today, but here's where people make the critical error. They evaluate this in dollars, not in compounding potential. $262 taxed away in year 1 at a 10% growth rate would have become $4,571 by year 30 if it had stayed invested. That's the real cost, not the $262. It's the $4,500 that never existed. And this happens every single year, not once, 30 times. But there's a compounding element to the drag itself. As Daniel's portfolio grows, so does the dividend payout. By year 15, he's not paying tax on $262. He's paying tax on something closer to $900 per year because his portfolio has grown and his dividend yield is still extracting the same percentage from a larger base. Ethan has none of this. QQ pays almost no dividend. The companies inside it, the Apples, the Microsofts, the Nvidias, retain their earnings internally. That money never becomes a taxable event for Ethan until he sells. This is the structural distinction. Daniel's structure forces a taxable event every single year, whether he wants one or not. Ethan's structure defers all taxation until he chooses to realize it. Over 30 years at 15% on a portfolio growing towards $600,000, the cumulative tax drag on Daniel's portfolio is not trivial. We're talking about a cost in the range of $40,000 to $60,000 in lost compounding, depending on the tax year and portfolio size. That alone is a meaningful gap. But taxes are not even the biggest problem. The structural issue underneath the taxes, the one that actually generates most of that $400,000 gap, is something that happens before Daniel even files a return. Stay with me. To understand this, we need to briefly talk about what a business does with its money when it doesn't pay it out. Return on equity, or ROE, is a measure of how efficiently a company generates profit from the money its shareholders have invested. A company with a 20% ROE earns 20 cents of profit for every dollar of equity on its books. Now here's the key question. What happens when that company earns a profit? It has two choices. It can distribute the profit as a dividend, or it can retain it, reinvest it internally into research and development, acquisitions, buybacks, infrastructure, and continue compounding at that same ROE. When a high ROE business retains earnings and reinvests them at 20%, that dollar isn't just growing at market rate. It's growing at the internal rate of return of the business itself, which, for the best companies, is far higher than what Daniel can achieve by taking the dividend check and reinvesting it externally. Here's the analogy I want you to hold on to. Imagine you own a factory. The factory has a machine that converts raw materials into $1.20 of output for every dollar of input. It's a 20% return machine. The question is, what do you do with the profit? Option A. You take the profit out of the factory every quarter. You put it in your pocket. You then have to decide what to do with it. Pay tax on it when you receive it, and try to find a way to reinvest it at a rate equal to or better than what the machine earns. That is the dividend investor's position. Option B. You take the profit and immediately feed it back into the machine. More input, more capacity, higher output next quarter. The machine upgrades itself continuously. That is the retained earnings model. What if I told you that the investor choosing to take cash every quarter is actually slowing down the machine? Not by negligence, by structure. Every dollar extracted from a high ROE business stops compounding at the business's internal rate and starts compounding at Daniel's external rate, which is, by definition, lower. This is the compounding engine differential. It's not about dividends being bad. It's about the mathematical cost of interrupting compound growth at its most efficient point, inside the business itself. And this cost is invisible on your brokerage statement. The statement will show you the dividend received. It will never show you the compounding opportunity that ceased to exist the moment that cash left the company. That gap between what retained earnings would have become and what the dividend check actually produces after taxes and external reinvestment is where most of the $400,000 lies. Let's run the actual numbers. And I want to be clear. These are illustrative projections using historical return assumptions. Past performance does not equal future results, but the relationship they demonstrate is structural. It holds regardless of the exact inputs. The formula driving all of this is simple. Future value equals present value multiplied by 1 plus the annual rate of return raised to the power of the number of years. This is the engine beneath every long-term investment outcome. Let's give both investors a 10% nominal annual return, a reasonable long-term approximation for diversified equity exposure over 30 years. The difference is that Daniel's effective return is reduced each year by tax drag on dividends and by the compounding engine differential we just described. We'll model Daniel's effective net compounding rate at 8.5%, accounting for the 15% dividend tax on his 3.5% yield and the friction of external reinvestment. Ethan's rate stays at 10%, his returns compound uninterrupted. Year 10, Daniel at 8.5%, approximately $113,000. Ethan at 10%, approximately $130,000. Gap at year 10, roughly $17,000, meaningful, not alarming. Year 20, Daniel, approximately $255,000. Ethan, approximately $336,000. Gap at year 20, roughly $81,000. Now it's a real number. Now it's a car, or a year of college tuition. Year 30, at this point, the difference is no longer linear. It becomes exponential. Daniel, at 8.5% over 30 years, approximately $575,000. Ethan, at 10% over 30 years, approximately $873,000. Gap at year 30, approximately $298,000. The compounding differential alone. Add in the direct tax drag on dividends paid out over those 30 years, cash that left the portfolio and was taxed before reinvestment, and the total structural cost to Daniel approaches $390,000 to $410,000, depending on exact dividend growth and tax assumptions. That is where the $400,000 figure comes from. It is not a headline. It is not a round number chosen for impact. It is the mathematical output of two different compounding structures running in parallel over 3 decades. What Daniel built is not a failure. $575,000 from a $50,000 investment over 30 years is a strong outcome. The question is what he gave up to feel the income along the way. There is one more layer to this. At year 30, Daniel's portfolio of $575,000 yields roughly 3.5% in dividends. That generates annual income of approximately $20,125. He doesn't need to sell a share to receive it. Now let's look at Ethan. His portfolio is $873,000. He applies a standard 3% withdrawal rate. a conservative, sustainable drawdown that financial research suggests can be maintained indefinitely under most market conditions. 3% of $873,000 equals $26,190 per year. The portfolio that looked less safe, the one without income, without the quarterly cash payment, without the psychological reassurance of a dividend, is actually producing more income than the one built specifically for it. This is the distinction between psychological income and mathematical income. Dividends feel like income. The cash arrives. You see it. You feel productive. There is a real behavioral benefit to this. For investors who might otherwise panic sell in a downturn, the dividend provides an anchor that has real value. I'm not dismissing it. But mathematically, dividends are not income in the traditional sense. They are a forced partial liquidation of your portfolio at whatever price the market happens to be that day. The dividend doesn't add value. It transfers value from the share price into your brokerage cash balance. The stock price drops by the dividend amount on ex-dividend date. You are richer by the cash and poorer by the same amount in equity. The net result is zero before taxes. After taxes, it is less than zero. Understanding this doesn't mean you should abandon dividend investing. It means you should be honest with yourself about why you're doing it and whether that reason survives this math. Now, before we close, I promised you there's a scenario where this entire analysis flips, where the dividend investor isn't behind, where the income structure isn't a cost, it's an advantage. That scenario is real, it's specific, and it involves a risk that destroys more retirement portfolio than any individual stock ever has. It's called sequence of returns risk, and it is the one variable that changes everything we've calculated so far. If you've made it this far and this analysis is useful to you, consider sharing it with someone still building their portfolio. The math doesn't care about age, but the strategy should. Stick with me for the final piece. Everything we've established holds during the accumulation phase, the 30 years when you are building wealth, not spending it. In that phase, the growth structure wins mathematically, consistently, and by a wide margin. But the moment you retire, the moment you switch from depositing money to withdrawing it, the equation changes. Here is the problem with withdrawal-based income from a growth portfolio. You must sell shares to generate cash. And if the market drops 30% in your first year of retirement, you are selling shares at the worst possible prices to fund your living expenses. You lock in those losses permanently. This is sequence of returns risk. A bad sequence of returns, specifically bad early returns, can permanently impair a growth portfolio in ways that average return calculations don't capture. Two portfolios with identical 30-year average returns can produce dramatically different outcomes, depending on when the bad years happen. This is the one phase where dividends stop being optional. A dividend-generating portfolio produces cash flow without forcing share sales. If the market drops 30%, Daniel still receives his dividend checks. He doesn't need to sell, he can wait. His principal remains intact to recover. Ethan, drawing down 3% through selling, risks a permanent ratchet down during a prolonged bear market at exactly the wrong moment. The intelligent framework is a life cycle approach. During accumulation, compound as aggressively as the math supports. Growth structure, retained earnings, tax deferral. As you approach retirement, roughly 5 to 10 years out, begin transitioning toward income-generating assets. Not because dividends are superior, but because the risk profile of living on withdrawals is structurally different from the risk profile of building wealth. The two strategies are not in competition. They serve different phases of the same financial life. We started with two investors, same $50,000, same 30 years, one ending with $400,000 less. The difference was never dividends versus growth. It was never income versus appreciation. It was whether the money was allowed to keep compounding, uninterrupted, untaxed, inside the most efficient engine available, or whether it was extracted, taxed, and handed back for external reinvestment at a lower rate. The $400,000 gap is not the result of a bad investment. It is the result of a structural choice, made once, carried consistently for 30 years, and never questioned. The most expensive financial decisions are usually the ones that feel the most responsible. If this breakdown changed how you think about dividends, even slightly, that's the whole point. Most of what gets shared about income investing skips the math entirely. We don't do that here. If you want the next forensic breakdown the moment it drops, subscribe. It takes 2 seconds and you won't miss it. And if you know someone still building their portfolio who's never questioned the dividend structure, send them this video, not to convince them of anything, just to make sure they've seen the numbers. I'll see you in the next one. Disclaimer: this content is for educational and informational purposes only and does not constitute financial, investment, or tax advice. Consult a qualified financial professional before making any investment decisions. Past performance does not equal future results. All figures presented in this video are illustrative projections based on historical return assumptions and are not guarantees of future investment outcomes.